Welcome to the Be Smart podcast, how not to be an idiot with your money. Today, we have a halfway decent episode lined up. We're going to talk about why you shouldn't go all in on stocks and how you can manage risk with options. First things first, Jared, you know I had to wear the hat. For those who don't know, Jared hails from Connecticut. He's a UConn fan. I was born in Gainesville, Florida, so naturally I was raised a Florida Gators fan. Our team faced off, and it was a battle. Probably going to have to go to the doctor to get some heart tests done after it, but what do you think?
I don't think you can win a game if you miss 18 three-pointers. Like, you got to make some shots. Connecticut they just weren't shooting well, you know? Defense was there. I think they played pretty well, but you got to shoot better than that.
Yeah, and Florida missed like 100 free throws too.
They missed 12, yeah.
Do you know how many they took?
No.
I was freaking out there in the whole game. I don't know if you remember the 2014 tournament. I don't know if you can remember all this way back. You're probably not as psychotic as I am about college basketball, but Florida was the overall 1 seed that year. They get to the Final Four. UConn was a 7 seed. They were on the same side of the bracket in a different region. They make their way to the Final Four, and they knock off Florida thanks to a heroic performance by Shabazz Napier. And they get to the title, UConn, to face an 8-seeded Kentucky. And Kentucky is a team Florida had beat 3 out of 3 times that year. During this game this past weekend, I was getting PTSD to 2014 because I feel like UConn kind of stole a title from Florida in 2014. So I was on the edge of my seat, but thankfully we're advancing. Yep. Who you got winning the whole thing? Any predictions?
That's going to be your toughest game the whole tournament.
UConn is a very hard out.
You did not like that bracket facing them in the second round.
All right, enough messing around. You want to go to the market headlines?
Yep.
The first one, the Federal Reserve's future policy path is highly uncertain as Powell downplays forecasts on heels of Trump unknowns. The Fed continued to signal it will cut interest rates 2 more times this year, with Fed Chair Jerome Powell adopting a perceived dovish stance, a pleasant surprise for investors who came into last Wednesday's policy decision with heightened fears over stagflation and the possibility of a U.S. recession. Your takeaways from the Fed meeting, Jared, and why is stagflation, as you recently tweeted, the most overused and misapplied term in finance?
Yeah, people say stagflation all the time. Oh my God, we're in stagflation. The Fed has higher inflation forecasts, lower growth for the curve. It's stagflation. It's not stagflation. 1979, we had like 14% interest rates. We had 14% inflation. We had like 10% unemployment. Like, that was stagflation. Like, we had negative GDP growth. We had recession and inflation at the same time. Like, people throw this word around, stagflation, like it's just not true. Like, it's absolutely not true. Like, it's not even close to being stagflation. Like, oh my God. So, but anyway, I think the takeaway from the Fed meeting is that it was a little bit on the dovish side, you know, with the lower growth forecasts. I don't think he really had any movement in the dots, but it was a dovish meeting, a little bit dovish. You know, I think if the stock market craps out another 10%, if we get a terrible payroll number, if any of these things happen, we could get a rate cut at the next meeting, 25 basis points. I think that's possible.
Do you still stand by your 6 cuts this year? I mean, this is predicting that they're factoring in 2.
I do for the time being, although that would take, so I mean, it's March 24th. So you'd have to have a pretty big collapse in the next couple of months in order for that to happen. I still think that is going to happen, but obviously the clock is ticking on that prediction.
Our next headline's from Bloomberg. Gold steady near record high with Trump aiding haven demand. In a recent newsletter, you wrote, buy it if it goes up, buy it if it goes down, and buy it if it sits still. Can you break down your thesis on gold right now, and why should people be buying it no matter the price?
Honestly, since I wrote that, I looked at a chart today, and there's a DeMark 13 on gold, which is a little ominous looking. You know, just as a general rule, gold, people try to make some fundamental sense out of gold. They try to do supply and demand on it. They try to say it goes up because of inflation or because of interest rates or whatever. Gold has nothing to do with fundamentals. It's all technicals. And as of last week, gold broke above 3,000. It held the gains. And I thought for sure, I mean, it was gonna extend the run another 5 or 10%. Like that's what I thought would happen. And it's kind of run into some resistance around 3030. It's not acting very well. It's not acting like what you would expect after breaking through a big technical level. So I want to moderate those comments I had earlier. I mean, look, like I just close your eyes and pretend it's like 5 years from now. Where do you think gold is going to be? Probably a lot higher. But in the short term, like if you're trading it, I'm actually a little more cautious than I was last week.
Next from the Wall Street Journal. Actually, before we even get into this, you recently canceled your Wall Street Journal subscription, right?
Yeah, and I'm kind of not so much that I'm regretting it, but there's like I mean, look, I could get an educational discount. I have a .edu email address because I teach at Coastal. Like I could get an educational discount and get like a really cheap subscription. Um, it's I don't want the physical paper. Like I actually, it's not even that I don't need it. I don't want it. Like I don't want to go out to the mailbox and get a paper every morning. I'm not going to sit there and read the paper. Like really, the only reason I would get it is like if I'm on Twitter and there's a Wall Street Journal article and I click on it and it's behind a paywall and I want to read the article. So how much do you want to pay for that? Well, you don't want to pay $400 a year. That's too much. How much would you pay? Well, maybe you'd pay $100 a year, right? So that's kind of where I am.
I have one. I have a digital subscription, and they actually send you the PDF of the newspaper, which is kind of cool. It's only $4 a month. Bloomberg is like 30 something a month.
I talked to somebody recently who said they were paying $800 a year for a Wall Street Journal subscription. So I don't know what kind of pricing plans they put people on. Like obviously you're on like a cheap plan. Um, I'm probably going to end up getting it again under the educational discount because I used to do that years ago. When I was teaching like upper level finance classes, I would have them read the Wall Street Journal and like we would discuss it in class. So I don't know. Maybe I'll do that.
Anyway, for the headline, how to tell if the stock market sell-off has hit bottom. So James McIntosh of the Wall Street Journal writes, it doesn't quite feel like it's time to buy just yet, but here are 3 tests to help you decide. And from here, he focuses on sentiment, leverage, and overshooting fundamentals. Even though sentiment has already soured, he says that there isn't enough panic to trigger his contrarian, quote, buy when I'm scared impulse. Do you agree, disagree, and how much emphasis do you put on trying to time the stock market? This was an article from last week, by the way. I know the market is up 1.5 today.
Who was that? I missed that. Who said that?
James McIntosh. He's the author of the article.
That's kind of where I am. We haven't really gotten that panic puke shot yet that I've been looking for. I mean, Tesla's up 10% today ish. After Tim Walz was flapping his arms on stage, telling everybody like showing the phone, the stock is down. And the move in Tesla actually accounts for a big part of the move in the S&P today. Yeah, I mean, it seems like just on a random Monday, like some animal spirits came back into the market. Like people are buying tech today, they're buying Bitcoin, they're buying crypto, like. So and bonds are down and like it's weird. Like so I don't know. Like I don't think we've had enough pain yet, which I think is what I said the last time I was on. Like it doesn't feel like it feels like we're getting off a little bit too easy.
Yeah, Tesla up 10%. Do you think that's all walls? That was ridiculous.
I think that a lot of it is, yeah.
Let's dig into this article for our first main topic, set it and forget it investing. The days of set and forget investing just ended for many Americans. President Trump's economic policies are sending investors out of U.S. stocks and into cash, bonds, gold, and European defense stocks. The chaotic mix of tariffs and government budget cuts has jolted legions of everyday investors, leading them to question the assumption that they should buy and hold stocks on autopilot. I mean, this is what the awesome portfolio and the strategic portfolio are all about, right? I mean, you could still invest with a lot of that day-to-day brain power. Obviously, don't just put all your assets into stocks, but What's your take on this idea of set it and forget it investing being dead for many Americans?
My book, The Awesome Portfolio, is going to come out in about a year and a half. And I think the timing on that is going to be pretty good because I think we're going to get a bear market. I think it's going to be a little vicious. And I think people are going to question this wisdom of basically this 2017 nonsense that you should put all your money in index funds and just buy every dip and dollar cost average and just hold it forever. The whole point of the awesome portfolio and the strategic portfolio is it's about managing your emotions as an investor, right? And as you can see, with the stock market down 10% from the highs, people are experiencing emotions, right? Like they're like, oh, I wish I sold a couple of weeks ago. I would have saved myself $20,000. I'm down $40,000. If it goes up a little bit, then I'm going to sell. Like these are the kinds of things you're hearing from people. Like really, an S&P 500 index fund is not a set and forget portfolio. It's too volatile. The drawdowns are too big, right? That's where the awesome portfolio comes in. Worst drawdown in the history of the awesome portfolio, 12%, which is about kind of about where we are right now with stocks, right? So I am, I don't know. I think the book is going to be a big hit. I think people are going to learn a better way to invest.
All right, we've got to talk about the Options Masterclass, which is coming up very fast. It should be out the beginning of April. Could you answer like a few questions for me here, such as what's the target audience for the course? And for those who are new to options, how can options help people manage risk in a more sophisticated way than you can with just stocks?
The target audience, I would say, is a smart person who uses options directionally, but who needs to know really the math behind how they work in order to get a better understanding of what they're doing, right? Like you have to know a little bit of the theory. I mean, I think there's a lot of people out there who know the hockey stick diagrams. Call option goes like this and a put goes like this, and they kind of know the basics. But unless you understand really and we're not doing any math in the course. There's no algebra, there's no calculus, there's no differential equations. We're not even putting any equations in the class, but there's a lot of mathematical relationships between the price of the stock, strike price of the option, interest rates, the time to expiration, and volatility. The relationship between these things mathematically is what you need to understand, right? So that's the target audience. What was the other thing you were going to ask me? Managing risk, something like that.
Yeah, how can you use options to manage risk better than you can with just stocks?
I mean, I think there's an art form to trading stocks just without using options, like just trading Delta One, as it's called. There's definitely an art form for doing that, but you're kind of limited as to what you can do. With options, you can create pretty much any payoff profile you want. Like if you want to create some kind of payoff where, okay, I don't want to lose a lot. I want to lose a little bit, but I can make a lot. You can create that payoff profile. If you want to create a payoff profile where, well, I want to make money if the market stands still, but I'll lose money if it moves a lot, you can create that payoff profile. There's just an unlimited amount of things you can do with options depending on your risk tolerance.
And what would you say sets your masterclass apart from some of the other books and courses that are out there?
The book that I read when I started in the business was Options, Volatility, and Pricing by a guy named Sheldon Natenberg. And that kind of goes through all the mathematical relationships that I talked about. The book I usually recommend that book to people, but the problem with that book is it's designed for market makers. And when I say market makers, I mean people on like a trading floor 20 or 25 years ago, right? And that doesn't really exist anymore. Okay. So there's a lot of things that were in that book that people just don't need to know. Like you don't really need to know about reversals and conversions. You don't need to know about jelly rolls. You don't need to know about all these financing trades. You don't need to know about margin. It just, nobody cares. So what I've done is I've taken the really good parts of that educational material and put it into a class and stripped out all the stuff that you don't need to know. Now, there is some stuff in there that is nice to know, but not necessary to know. But I didn't clutter it up with stuff that you don't need to know.
Last question on the masterclass, and I do not want to give too much away here, but there's something you wrote in there that I want to kind of get your thoughts on. You wrote, if you understand volatility, you understand options. Can you break that down? What's the importance of volatility? Just briefly, because like I said, I don't want to spoil anything here.
If you're trading options, you are trading volatility. The volatility is the price of the option, right? And a lot of people don't understand that concept at all. It's funny, we got some feedback when we sent out the first module, right? And some people were like, really? Like option trading is volatility trading? Like, I had no idea. I did not even know. Like, when you're talking about option traders on Wall Street, you don't even call them option traders. You call them volatility traders. That's what it's called. It's the same thing. These are some books that I read when I was new in the business. This is the Natenberg book, Option Volatility and Pricing. And this is another one, which is, this has been out of print for like 30 years. It has a great title, Options, Perception and Deception, by a guy named Charles Cottle. And this is really a market maker book. Got some great graphs in here, but this is really for trading options on the floor. That's the thing that with it, all these books have in common. They're really meant for market makers.
Okay, let's go over the mailbag because we got one lonely comment from our last video from Video Smurf. This one's pretty good. The argument about tariffs being deflationary is the dumbest thing I've heard since Trump's last tweet. Jared, your response to this comment?
Well, he said that the tariffs being deflationary is the dumbest thing he's ever heard.
Yeah, since Trump's last tweet, even though Trump isn't on Twitter, is he?
Well, that's not a very nice thing to say.
I want him to offer up some more just to back up his point. If you're watching this video, Smurf, I want to know why you think tariffs as a deflationary force is the dumbest thing you've ever heard.
I don't really feel the need to explain myself again. Like I talked about in the last podcast, why they're deflationary. I mean, just look at the evidence. Like, inflation is dropping. Whether you want to look at truflation or whether you want to look at the last CPI number, like, inflation is actually going down. It's not going up.
Yeah, me neither. Also, you know what I find funny when people online just kind of try to riff on a take and they can't even string together a grammatically sound sentence. Come on, Video Smurf. You got to clean up that sentence there. He's got some missing stuff in there, like Trump's no apostrophe.
If you're going to come at the king, your grammar had better be correct.
For the week ahead, we are getting a reading of the Fed's preferred inflation gauge, PCE, plus updates on activity in the manufacturing and services sectors, consumer confidence, and the final reading of fourth quarter economic growth. Anything else you're watching closely this week, Jared?
Just PCE. I'm expecting PCE to come in lower on the dropping inflation theme. But no, not really. Not looking at anything else.
That's all I got for you this week. Everyone, please subscribe to the channel. If you like this episode, please give us a like. Drop us a comment or question below, and we'll address it in a future episode. Until next week, peace.